Good evening, everyone. I think till the time we get the screen ready, how many of you have cleared that SIF exam? Very few. That clearly shows that today, out of more than, you can say, 150,000 registered distributor, less than 5,000 are selling SIF. But still, in the early days, we have not even completed, you can say, 8 months. The category is more than 15,000 crore. If I put in context, arbitrage fund, how many of you have sold arbitrage fund? I think much larger audience in that context. The first arbitrage fund started in 2005. And in 2014, after 9 years, the category touched 5,000 crore. Today, there is a replacement of that in the form of hybrid long short SIF. The category started 7 months ago. Today, as we speak, has already touched 10,000 crore. So that clearly shows that though a lot of distributors have not cleared the exam, a lot of people are still not aware about the nuances of SIF, but still the category is growing, and it is in interest of all of us and all our clients that sooner we learn about it, adapt to it, and start selling it, it will be useful for all of us. I think for us, I am from Edelweiss Mutual Fund. As you all know, we have been, it is version 2 of Edelweiss Mutual Fund. We started in 2009. From 2009 till 2016, our total AUM was less than 1,500 crore. And that was the time where we decided that we are not going anywhere. If we move with the same pace, we will be an immaterial thing in an overall mutual fund space. But that is when we acquired an AMC which was 5 times bigger than us, JP Morgan. And from that time, this is version 2 of Edelweiss. After that, we successfully, you can say, onboarded the entire team from JP Morgan. After that, we also won the mandate for Bharat Bond. And today, we are one of the very few AMC which have all the 5 platforms available. I think we are the first one and one of the very few even now. So we have active fund, passive fund, we have gift, we have, you can say, SIF, and we also have international funds. So that has been our journey over last many years. One unique thing about Edelweiss, we always have 3 investment verticals. Normally, if you will see in most of the AMC, there is a fixed income team and there is an equity team. But at Edelweiss, from day one itself, we always have 3 separate teams. One was equity fundamental. Second, which I am part of, it was equity factor. I just heard some conversation on momentum, value, growth. That was the team, what we are doing from 2009 onwards. And the third is our fixed income team. The unique way of measuring this, you can say, managing money, has helped us to be, you can say, in a way, pioneer in a lot of things. To, in a way, to start something which a lot of AMC would have normally taken a lot of time. But because of, you can say, diversified team and flexibility to manage a lot of things in a different way, that has always been the uniqueness of Edelweiss. Now, coming to SIF, I think when SEBI launched or brought this idea of SIF in February 2025, the main purpose was there was a huge gap for an investor. Either you can start in mutual fund with smaller ticket size, 1,000, 5,000, 10,000, 20,000. And then if you have to upgrade yourself, the next available option was directly PMS and AIF, which was with an entry size of 50 lakhs and 1 crore. Second, mutual fund was becoming a commoditized product. Either you can be investing in large cap, so all large cap fund will have 80% same stock. If it is mid cap, all mid-cap fund will have same 150 stocks, 65% portfolio. As a fund manager, even if I am negative on market or a particular sector or a particular stock, I cannot make money by taking a short position in that stock. Because as per regulation in mutual fund, we can be only long only. We cannot short. We can hedge, but we cannot short. That was the challenge. On the other hand, you have AIF with all the flexibility. You can take leverage. You can take 100% short exposure, no restriction on mid-cap, small-cap, large-cap definition. So that was a totally, you can say, flexible thing compared to mutual fund, which was very rigid. But the biggest advantage for mutual fund was equity taxation, mutual fund taxation, which was much better compared to all your AIF and PMS. Now that taxation advantage was always the single most reason why mutual fund today are much larger compared to any AIF or any PMS. But as I said, mutual fund had its own challenges, AIF had its own challenges. That is where SIF becomes a very attractive product, because in simple word, SIF is nothing but a mini AIF with mutual fund taxation. When I say mini AIF, entry ticket in AIF is 1 crore. In SIF, you can start with 10 lakhs across all the 7 schemes put together. So relatively smaller ticket size. In AIF, you can go 100% short. In SIF, you can go only 25% of your AUM as naked short exposure. So some limitation over there. In AIF, you can take leverage. In SIF, you cannot take leverage. That's why it is not a full-fledged AIF. It is a mini AIF. But compared to mutual fund, the flexibility has gone up significantly. Today, each and every mutual fund category can be replicated in SIF with much efficiency on flexibility part of it, usage of derivative, no restriction on minimum amount of money should be in top 100, 101 to 250, etc. So a lot of flexibility, and that's why in coming time you will see SIF will become much, much bigger compared to existing mutual fund scheme within the same, you can say, within the same bucket. So like in mutual fund, you have equity scheme, debt scheme, and hybrid scheme. Similarly, in SIF also, regulator have introduced equity scheme, debt scheme, and hybrid scheme. The advantage over here is, if you read on the board, all the schemes are known as long-short fund. Whether it is equity long-short, whether it is debt long-short, whether it is hybrid long-short, all of them are named as long-short. And because all of them are long-short, they cannot be part of my normal mutual fund schemes. That's why each and every AMC is launching a separate brand name, and all SIF compulsorily will be launched under that separate brand name. Like in our case, we have launched Altiva as our brand. So all my long-short strategy, all my SIF will be part of Altiva brand name. For first 5 years, you will see Altiva by Edelweiss Mutual Fund. After 5 years, that by Edelweiss Mutual Fund tagline will also go away. So now if you will see, all of them are known as long-short fund. That means each of the SIF scheme can have 25% naked short as an option. There is no compulsion. So as a fund manager, if I don't want to take short position, I can always avoid shorting. But that flexibility to use shorting either in a form of a tactical allocation or a structural allocation is purely up to the mutual fund or individual fund manager. Now, if you read all the 7 categories, the most popular one is hybrid long short. When I say most popular one, because out of 12 AMCs which have launched or have filed for SIF, 9 of these 12 AMCs have launched hybrid long short as one of their first few products. That clearly shows the popularity of it. Beyond that, the reason why everyone is launching this product, because today there is an absolute requirement of this kind of product in market. If you are an equity investor, today you have multiple options to invest from. You can, if you are an aggressive equity investor, you can invest in active fund, passive fund. You can invest in large cap, mid cap, small cap. If you are a conservative investor, again, you can invest in balanced advantage fund, aggressive hybrid fund, or any other product. But if you are a fixed income investor, what are the options available to you today? Normally, you used to put money into fixed income mutual fund, but taxation has killed it. Your indexation benefit has gone. Your long-term, short-term capital gain tax benefit has gone. So today, if you are investing in a pure fixed income scheme, to generate post-tax 5% return is also a challenge. As a result, investors started moving into arbitrage as a category. Earlier, it was only arbitrage fund. Now you have arbitrage fund, income plus arbitrage fund of fund. You have Edelweiss multi-asset arbitrage fund. Multiple options available. But finally, all these products are linked to short-term interest rate in economy and equity market sentiment. Because of, you can say, subdued sentiments over last almost 18 months now, you will see return of arbitrage fund. Still, they are better than liquid by 50 to 100 basis points. But on absolute basis, now you are not making post-tax return of 6%. So your original return of debt before indexation benefit was taken away was 7, 7.5, 8. Now in chase of that 8% return, because of lack of option, people started venturing out into 2 ways. Either they increase their risk appetite on the fixed income side, and they started doing structured credit, performing credit, CAT to AIF, a lot of other options, or they increase their risk appetite on the equity side by going into hybrid fund. You started investing in equity saving fund, balance advantage fund, aggressive hybrid fund, with an hope that by taking some naked equity, I will generate that 8%, 9% post-tax kind of return. Now, even that equity risk comes with own volatility. During COVID, when markets were down 40%, most of your aggressive hybrid funds were down 30%. Most of your balance advantage funds were down 20%, and a lot of your equity saving funds were also down 10%. So a pure fixed income investor cannot look at a product where you are trying to find out a replacement to fixed income, but your downside can be 10%, 20%, or 30%. And that is the gap which a lot of AIF or a lot of SIF on the hybrid side are trying to fulfill. We are trying to launch a product, or we have already launched a product. We have completed 7.5 months now. We started in October last year with an NFO AUM of around 300 crore. And today as we speak, we are happy to share, we have crossed 4,500 crore. So 15x growth in less than 7.5 months. We are the largest SIF in the country today. When we started the competition, someone who started on the same day with us was 4 times bigger than us. We were at 300, the competitor was at almost 1,200. And today we are at 4,500 and that fund is still at 3,500. But as I said, this is still early days. The category is just 7.5 months old. But we have been able to launch a product where by doing simple stuff, by just managing asset allocation and using the flexibility given to the SIF, we are able to launch a product where on a post-tax basis, we can deliver 8 to 9% return, which is significantly higher than your fixed income and also reasonably higher than all your arbitrage-related product. So the internal benchmark what we have set for ourselves is arbitrage plus 3% return on a post-tax basis. Now, how do we do that? We are investing in 4 different buckets, starting from arbitrage and fixed income. Whatever arbitrage fund do, we are also going to do. And 70% of my portfolio, 60 to 70% of my portfolio is pure arbitrage and pure debt. Whatever is available in arbitrage fund, 70% of my fund is also in that 2 buckets. We have added 2 new things over here. One is special situations. IPO, open offer, merger, demerger, block, QIP, warrants issue, partly paid up, all kind of tactical trades, which can be a 1-day trade or can be a 1-month trade or can be a 1-week trade. We'll be doing all those trades and trying to enhance our return. Historically, by doing all these trade in our existing funds, like equity saving fund, balance advantage fund, aggressive hybrid fund, on an average, we make 2 to 3% return. Here we are saying that we will be doing the same thing with much better flexibility, much better efficiency, and still conservatively we are saying we will make only 1.5% return from here. And fourth, and so special situation is not new. We can do it in our aggressive fund, aggressive hybrid fund, equity saving fund. The only thing is you cannot do special situation in your pure arbitrage fund. That is something now we can do in SIF. I cannot do IPO in my arbitrage fund. I cannot play demerger in my arbitrage fund, but I can do in SIF. So that is the first source of alpha from where we will generate extra return. And second, or the last thing, which is totally unique, totally new, today you are not allowed to do that thing in mutual fund. That is all your derivative trades. All your straddle, stangle, covered call. We are doing all these things. That is almost 40% of our portfolio. So 30 to 40% of our portfolio will be into derivative strategies. Normally, all these derivative strategies, I'm sure a lot of you will be dealing with HNI clients. When they do it individually on their book, on an average, this strategy generates 1.5 to 2.5% per month, which is 18 to 30% on an annualized basis. But derivative have its own risk. In extreme volatility, like what we saw in March 2026 or before in March 2020, whenever there is extreme volatility in market, derivative strategies can incur mark-to-market losses also. And that's why this is not 100% risk-free or 100% safe like an arbitrage fund. But you can manage that volatility in a much better way, which you cannot do in your equity saving fund or in your balance advantage fund. So by doing all this strategy where your potential return is anywhere between 18 to 30% on an annualized basis, 1.5 to 2.5% per month, we are saying, we are taking a very conservative number. We are saying even if we make 10% return from this strategy, we are more than happy. We are more than enough to meet our objective of generating 10 to 11% gross return, post-fees, post-tax return of around, post-fees, you can say return of around 9% and post-tax return of around 8%. In the last 7 months since we started, the circumstances within which these 7 months have completed, Nifty has been negative in 5 out of last 7 months. Interest rate since our launch have gone up continuously. That means even debt have mark-to-market losses. And you all are aware, because of the geopolitical situation and the volatility in underlying equity market, we hardly had any good IPO, open offer, merger in last 4 to 5 months. And even after all these challenges, still when you look at the performance of our fund, we have delivered around almost 10.5% return in our regular plan, which is almost 5% higher than arbitrage fund on a post-fees, post-tax basis. Though we started by saying that we want to generate 3% alpha in a period which is not suitable to our strategy, because equity market is not helping you, interest rates are going up, special situations are not coming, and still we are able to generate significantly higher return. So that is something which we wanted to highlight. If you will see from a risk return analysis, when we did backtesting, the strategy is somewhere between pure arbitrage fund, which is 100% hedge, and equity saving fund, where you always have minimum 20, 25, 30, depending on which fund you are selecting, percentage of naked equity. My portfolio doesn't have any naked long position. Whatever long position we have is either in the form of special situation, that is IPO, open offer, merger, demerger, or in the form of covered call, or in the form of derivative strategies like straddle, strangle, pair trade, etc. We don't have a fundamental long portfolio or a fundamental short portfolio. Our entire equity allocation is tactical in nature. And every month, because we have monthly expiry, every month our portfolio goes under a huge change depending on what happens between the expiry. So if you will see return-wise, we are much better compared to an arbitrage fund, almost delivering return of around what equity saving fund is giving you, close to 11.5%. So these are gross return of all the product. We have added back the expense ratio so that everything is apple to apple and comparable with each other. So debt gives you 8.5%, but post-fees, post-tax, it is very difficult to get 5%. Arbitrage fund gives you around 8% return, post-fees, post-tax, that number is around 6%. Our strategy gross return is around 11.5%. 1.5% expense ratio, NAV return of 10, and after that post-fees, post-tax, this number is almost 8 to 8.5%. So this is something what we have already done, we have already proven, and we have a track record of more than 7.5 months now. And in between, if you will see, the AUM growth from 300 crore to almost 4,500 crore is something which we will be able to, you can say in a way, showcase that this strategy can work at a size also. In fact, our best month was April, where we were already at 3,800 crore. So as I said, there are different strategies which will work in different market environment. Some strategies will help us in a bear market, some strategies will help us in a bull market, and some strategies will help us in a range-bound market. But the flexibility given to the fund manager is so high that irrespective of underlying market condition, as we have already seen in last 7 months, there was a March where Nifty was down 12%, Nifty falling double digit in a month. This is something which has happened only 3 times in last 16 years. And it has happened as soon as we launched the product. So one of the very rare thing, and we have experienced that also. Then second, Nifty being negative 4 consecutive months, December, Jan, Feb, March. Again, one of the very rare thing which has happened very few times, but as soon as we launch, we have experienced that also. And also geopolitical situation, war-like situation. Even after all these things, the strategy has been able to deliver as per the mandate. So that is the update which we wanted to give from my end. As I said, the flexibility given is so huge. I'll not go into individual strategies because some of them is known to you, like equity derivatives, special situation, and something which, as I said, these are the 5 things which we can do in mutual fund. Even with, you can say, only these 5 options in our normal schemes, we make 2.5 to 3.5% return. Because in mutual fund, I cannot go naked short, I cannot sell options. There are a lot of restrictions. Still, this strategy generates 2.5 to 3.5% return with this 5 strategy. But now when you look at SIF, this 5 strategies has gone up to almost 7, 8, 9 strategies. So much better options, much better flexibility, and much higher number of strategies. And still we are saying that we will make only 1.5% return. actual return can be significantly higher by doing all this thing. So again, one important strategy what we have is IPO. I'm sure a lot of people will have questions that if you invest in IPO, what is the guarantee that you will make profit? IPOs can list at a premium, IPO can list at a discount. But for that, we are the only fund house in the country today which already run an IPO dedicated fund known as Edelweiss recently listed IPO fund. I'm been managing that fund for last almost 8.5 years now. And the track record over there is significantly, you can say, better compared to the benchmark. We have been outperforming the benchmark by almost 5 to 8% across different time period. And that shows how good we are in selecting IPOs. So if you will see, in FY21, there were 29 IPOs. And the median listing day gain of that 29 IPOs was around 20%. Even after running an IPO dedicated fund, out of that 29, we invested only in 12. And look at our median listing day gain, instead of 21, we generated 52% return. So that clearly shows that we had an edge on selecting IPOs. The experience of managing IPO fund over last 8.5 years is something which will help us going forward also. So this is something where again, if you'll see, risk management becomes a very important tool because you know we are dealing with derivatives. Particularly, we are selling options, we are selling call options, put options, doing straddle, strangle, covered calls, so many derivative things. So risk management is also very important. So we have an independent risk team which looks at all our portfolio risk on a day-to-day basis. So overall, taxation-wise, that is some difference where you will find, as I mentioned, in SIF also, you will have equity SIF, where equity is more than 65, straight away equity taxation. You will have fixed income SIF, where debt will be more than 65, straight away fixed income taxation. That is taxation as per your slab rate, is irrespective of your holding period. And then you have hybrid SIF. Hybrid SIF have a unique taxation structure because all hybrid SIF, as a rule of SIF, cannot have daily redemption. In SIF, we cannot give you daily redemption, and that's why all hybrid SIF compulsorily have to be listed on stock exchange. And now because they are listed on stock exchange, even though we don't have more than 65% in equity, our taxation after 1 year is 12.5% long-term capital gain tax. The only difference compared to an equity SIF and an hybrid SIF is, if my equity is less than 65, up to 1 year, my taxation will be as per your slab rate, not as per short-term capital gain tax of 20%. Short-term taxation will be as per your slab rate, and after 1 year, you will be charged 12.5% long-term capital gain tax. So normally we think that taxation, it is a 1 year product, so ideally one should come for 1 year. But because we are dealing with derivative, we are working on special situation. We have seen last 4 months, there is no IPO. And then we have seen December, where there were 4 good IPO, plus Infosys buyback, plus Bharti partly paid up shares. So a lot of trade coming in a single month. So you don't know when that next December will come. That's why ideally we say that your holding period in this strategy should be 12 to 24 months. This product can be a replacement to all your traditional fixed income investment. Wherever your client was searching for that 6%, 7% return, this product can be replacement for all your Cat 3 long short AIF. If a Cat 3 long short AIF want to deliver 8 to 9% return, their gross return have to be 15, 16. They make 15, 16% return on your gross basis. After that, you have management fees, profit sharing, and then full tax. And after that, you get 8 to 9% return. Now, because they have to chase 15, 16% return, we have seen they take some extra risk, they take some unwanted risk, and when that risk backfire, we have seen in a single month, there are funds which were down 5% and 8%, and the entire 1 year return has been taken away. So that is the biggest advantage what SIF gets: equity taxation, mutual fund transparency, smaller ticket size, and still efficiency of derivative trading and flexibility of derivative trading makes it an attractive product. So this is the brief which I wanted to give from my end. Any specific questions anyone have? I'm more than happy to take that on SIF or all the other strategies what we have. Yeah. Someone can give mic.
Hi sir, thank you. So I really like your product and I do quite a lot of LTV long short. So I have 2 questions, very nuanced. First, I have seen in last fact sheet your debt YTM was 8.24, something around that. So I just want to know what kind of rated papers you have taken there, number one. Number second, I have seen last 5 months, the return was majorly made by covered call. And if the direction of the market changes to say bull, so how do we actually keep making the money? Thank you.
Sure. I'm not sure I've heard the question properly, but I will just try to answer. So debt YTM when we started was around 7.5. And in last 7 months, interest rates have gone up. So debt YTM accordingly have gone up to almost 8.1, 8.2. And that's why we said that debt in last 5 months had not been favorable. We have mark-to-market losses. And even after that, we are able to deliver better return. And as you rightly mentioned, the returns which are coming on the higher side are purely because of our derivative strategies like covered call and straddle and strangle. And in last 7 months, it is not that market have moved in a single direction. We have seen March, where market was down 12%. We have seen April, where Nifty was up 7% in a month. And then we have seen December, Jan, where market was down 1%, 3%, and November, where markets were up 2%. So flattish market, range-bound market, bull market, bear market, everything has happened in last 7 months. And we are happy to inform, other than March 2026, where Nifty was down 12% and this fund was down 1.5%, all remaining 6 months we have been positive. So Nifty is negative 5 times, positive 2 times. We are positive 6 times, negative 1 time. If I look at daily return, Nifty in last 7 months, roughly 200 days, has been positive 100 days and negative 100 days. Whereas in our case, we are positive 135 days and negative only on 65 days. That means there are 35 such days where markets were negative and we were still positive because of all the strategies which are in a way fixed income oriented, whether it is debt, whether it is arbitrage, whether it is covered call. In covered call, we say covered call as an arbitrage strategy, though theoretically it is not 100% hedge, but just look at the maths. We take an example, we buy Reliance at 1500, we sell Reliance future at 1510. That is pure arbitrage. I am making 10 rupees or 60 basis point as my arbitrage spread. Now Reliance can go in 3 directions. 1500 can go to 2000, 1500 can remain 1500, or 1500 can go to 1000. If I do a pure arbitrage in all the 3 directions, my profit is 10 rupees, it will not change. And that's why in March 2026, even when Nifty was down 12%, all arbitrage fund delivered positive return. Covered call is slightly different. Here also I am buying Reliance at 1500, but instead of selling Reliance future, I am selling Reliance deep in the money call option. When I say deep in the money, Reliance is trading 1500, I will sell 1400 call option. That means inbuilt protection of 100 rupees is there. So I will sell 1400 call option, say for example at 130 rupees. So my effective future short price, a notional future short price now is my strike price plus premium, 1400 plus 130, 1530. In normal arbitrage, I was making 10 rupees. By doing covered call arbitrage, I am making 30 rupees, almost 3 times. Why I am getting this 20 rupees extra? Because this is not risk-free. I am taking a risk. Now same 1500 Reliance can go to 2000. My profit of 30 rupees will remain intact. 1500 Reliance remains 1500. Still my profit of 30 rupees will remain intact. Even if Reliance falls down from 1500 to 1400, which is my strike price, still my profit of 30 rupees is intact. I bought Reliance at 1500, it became 1400, I lost 100 rupees in equity, but at 1400, my 1400 call option became 0. So I made 130 rupees in option. Still my profit is 30 rupees. But as soon as Reliance falls from 1400, my profit will start going down. And that's why the maths is very important. First, my break even is 130 rupees. That means 1500 to 1370, which is roughly 9%. In all the month where Reliance is down more than 9%, I can lose money. Now first, what is the probability? I am taking example of Reliance. It can be any other stock. I have a portfolio of 60 stocks. What is the probability that entire portfolio of 60 stocks will fall more than 9% in a month? As I said in the beginning, it happened 3 times in last 16 years. And in those months, we will lose money. So when we did backtesting, we showed our backtesting result of 2020 March, a COVID month. Nifty was down 23%, we were down 3%. But backtesting being backtesting, no one was 100% convinced, 100% confident. But today we have live data. March 2020, Nifty was down 23%. This time in March 2026, Nifty was down 12%. Exactly half of that. And in March 2020, backtested number, we were down 3%. In this actual fall, we are down 1.5%, exactly 50% of that. So the strategy is now being tested in live environment also, and in one of the rarest month, which has happened only 3 times in last 16 years. So that gives us a lot of comfort. Otherwise, in all the bull market and all the sideways market, we are happy to make 1 to 2% return per month. So we are not targeting equity plus return. We are not targeting mid-cap plus return. Our target is arbitrage plus 3. So till the time we are able to deliver 9 to 10% return, irrespective Nifty is positive 20 or negative 20, we are happy with that kind of return. Yeah.
Namaste. Sir, you mentioned there are around 150,000 distributors, may only 5,000 distributors have cleared SIF exam. So is there a possibility where mutual fund companies use a fund of fund route and where the underlying assets will be SIF?
I think that will be a complicated idea. Simple idea is the NISM and SEBI are going to ease off the exam, and it will be part of your normal distributor exam going forward. So whatever exam you pass for clearing your ARN certification, SIF will also become part of that exam itself. And I think in next few months, you will see that getting implemented. So it will become much more easier. Today, mutual fund and SIF, though both are part of Edelweiss, you cannot switch from SIF to mutual fund or mutual fund to SIF, and there are so many obligations. You can say there are 2 separate entities. So fund of fund can be an idea going forward, but as of now, I think because this is still relatively new and we have very few funds available, first the AMCs will try to fulfill all the 7 mutual fund schemes, all the 7 SIF schemes which are given, and this is just version 1. Very soon you will see new set of SIF also getting approved, and some of the complicated one like inverse SIF, leverage SIF, a lot of new funds will also come. So I think a lot of things will happen within SIF itself rather than thinking of fund from mutual fund to SIF. So we have to just see this is an early day, and there are a lot of better opportunities which will come over here. And I will still urge everyone to clear that exam. Exam is becoming more easier. Today, in that exam, there is a 50 marks weightage given to currency derivative. Very soon, that will be eliminated. So exam will relatively become easier and also relatable, because as a mutual fund, I cannot trade in currency. So there is no use of passing that currency exam. So all that things have been taken care of, and I think in next few months, you will see a lot of changes, and obviously ease of operations will also come in with that. Any other questions on SIF or our strategy? So last, I think, one more update from our side. This was our first SIF. We have, our second SIF is also going on. NFO is already running, which is on X Top 100. As I said, the beauty of SIF is the flexibility given to the fund manager. We have launched the second product, which is X Top 100 Long Short Fund. And as the name suggests, this is a replacement to your traditional mid-cap fund, traditional small-cap fund, a lot of your PMSs, because again, you are getting an efficient product with mutual fund taxation and the flexibility. Today, when you select at a mid-cap fund, 65% have to go in the same 150 stock. Today, when you select a small-cap fund, 65% have to go out of top 250 stocks. So regulation tells you where I can invest. But in SIF, it tells me where I cannot invest. The fund name is X Top 100. That means 65% of my AUM should be out of top 100. Whether it goes to mid-cap, small-cap, micro-cap, multi-cap, hedge position, long position, short position, AMC to AMC, we will decide. And that is an attractive product what we are launching. So the fund what we are coming up with is an aggressive product. 90% of the portfolio will be deployed in mid-cap, small-cap, and micro-cap. The universe is 101 to 750 market cap company. In these 650 companies, we will select high conviction ideas, 35 to 45 ideas, and we will invest only in that. As I said, derivative, shorting, etc. is an option which may not choose to use in our X Top 100 fund. So 90% of the portfolio will be long only portfolio, very interesting idea, managed by our equity CIO, Mr. Tridhi Bhattacharya, and fund manager along with him will be Nikhil Gada, who have recently joined us from Abacus. So do look at that product also. I think an aggressive product, particularly in current market environment where things have started increasingly looking better. Once these geopolitical issues settle down, I think it will be a good run-up what we will see, particularly into mid-cap and small-cap. And that will be a great product to manage that upside. With that, I'll just take a pause. Thanks, everyone. Thank you.